Welcome to AXIOM Founders Family Office, our first presentation of death, taxes, money, and the law. I'm superstar CPA Thomas J. Marki. The other half of AXIOM Founders Family Office is Armando Roman. Armando, you're a financial advisor, so all you do is talk about stocks and investments, right?
That's the least that we talk about.
Maybe talk about comprehensive financial planning and maybe touch on how taxes, why you kind of wanted to talk about that today.
Yeah, certainly. And today is actually pretty good. And the question you just asked, because I spoke with a founder who's going through a sale of his business, and he told me that he has an investment advisor, but all he does is invest, and he cannot talk to them about his trusts, about the liability he has, the impact on his family once his company sells, the insurance on his home, on his cars, what types of trusts, and are they the right types of trusts, taxes, all this other stuff that has nothing to do with investments, that he cannot talk to them about that. And so for us as financial advisors, as wealth advisors in this space, we have to understand so many areas and know when to bring in the right people to have more conversations about these areas, because the whole wealth advisory space is much more than just how do I invest my money.
That's right. And that's one of the reasons why I joined this firm. My background a little bit, I was a financial advisor and then decided to join a couple of CPA firms local that did tax returns. And holy cow, our taxes, that's one of the biggest impacts on our clients' lives. So as you can see, Armando, can you see the screen that I shared?
I can, yes.
Okay. So this is our one of our checklists. So we have a client customer service model in which we monthly send out some checklists to our clients to kind of try to stay top of mind. Our clients are busy folks, they're business owners, they have families, etc. And they're not always thinking about investments or taxes or estate planning or charitable giving. This is one of the checklists that we send out to our clients, which is as someone who is working, what issues should I consider reviewing your 2024 tax return? So, as part of our customer service with our clients, we request a copy of all their tax returns. Now, we don't do tax preparation in this office, but we do heavy duty tax planning. So, back to we always want to make sure that the tax returns are filed correctly and the appropriate planning is done for not only this year, but the years coming up. And as that planning is done, those tax returns are also filed correctly. So, let's kind of maybe start up right here at the top, Armando. We got one of the subjects here, family and filing issues. We heard about a big new bill that passed recently, and one of those was that they increased the standard deduction. Maybe touch on that and maybe some of the stuff on Schedule A.
Yeah, so the tax bill that passed the week of 4th of July is a brand new bill. The tax experts out there will have to dig into it and understand really what it means. IRS will have to do make some change to their forms before tax filing season. So the whole point I'd say about a new tax bill is everybody's got to make sure they speak with their tax person so that they're clear on what they should or shouldn't do before December 31 or by December 31 so that it can take effect this year. Because the way the tax year works, it's got to get done by December 31st in most cases. Otherwise, it goes into next tax year. So the standard deductions are pretty much a base, a core part of the tax return. It is what it is. Sometimes they change with the new tax laws, but it's just a flat amount that helps to reduce the taxable income for every individual and everybody who's on your return. Always stays out. It's always things that change in the whole picture, but the standard deduction is something that everybody gets to make use of in their taxes.
I'll touch on that. I'll piggyback on what you're saying. We have in-house a 100-point checklist that we go through for each of our clients. One of the tax planning ideas that we kind of like to talk about is charitable contributions, which is part of that Schedule A. So, with our clients being charitably inclined, the tax code is kind of favorable to that. So, we definitely bring up donor advised funds. We bring up CRUTs. There's different types of trusts that you can use that you can donate money to. We love the donor advised fund. We've had numerous clients who had highly appreciated stock, and they contributed that to their charities, and now they send that money out through the donor advised fund periodically. They don't do it all at once, but they get the tax deduction for that year. So, as an example, one of our clients had a $300,000 highly appreciated stock. They donated that to the set up their donor advised fund on their Schedule A to get that tax deduction in that year. But then they don't have to put that money out, send that money out to the charities all in that year. And so they were doing $100,000 a year on their Schedule A. Now they can still do that. Same, that hasn't changed their lifestyle one bit, but they get a huge tax deduction from the IRS. Any other stuff on here in this first section you gotta want to touch on, Armando?
Um, Dependents, as the kids get older, they drop off as they go to college, then they get their own work going, they drop off. Just makes the point that you've got to constantly revisit, are you still doing the right thing? Because life and families change from one year to the next.
Okay. Let's touch on the next section then. We got investment income issues. Um, how do we deal with that in-house here? What are your thoughts as far as
Well, that's a pretty big issue. It sounds like it might be really simple, but actually, as you know, Tom, it's not because people have their monies in different types of accounts. So Roth IRA versus IRA, yes, they're both IRAs, but when you pull money out and every single dollar you pull out is taxed at ordinary income rates, which are the highest rates. But the other bucket, the Roth IRA bucket, every dollar you pull out is not taxed at all, not a single penny. So a major, major difference on how that account is handled for tax purposes, which gets to the point that when you think about your investments and where they are, it's super important to understand the tax impact of moving monies around and pulling monies out of accounts. Ordinary tax rates are the highest. Some of the lowest are capital gains. And then some income is just not taxed at all. So municipal interest income, it's not taxed. So it's just important to understand where you have those monies, what are the investments in those accounts, and what will be the tax impact. So from our perspective, as we're planning for the family, then we can look at these different levers, understanding how to get to that sweet spot where we can maximize the positive impact for the family because we know how to do that based on our experience and skill set.
yeah, that's huge. I mean, holy cow, that tax code, it's hard to understand. And all these calculations, whether it be AMT, NIT, capital gains, etc. But that's part of the value we bring to the table. We had a client building a custom home. They needed to put a down payment on this home. Which accounts should they pull that down payment from? That was his question to us. So he had multiple taxable accounts. He had qualified accounts. He has a Roth accounts. We got together with the money manager and also the tax CPA does the preparation. We got a game plan going because what you don't want to do is that the stock market's down, be selling off assets to create this down payment money. The other thing you don't want to do is create short-term capital gain losses because that's taxed at ordinary income tax rate. So a lot of our clients have done an incredible job accumulating assets. Our job is to make sure we efficiently draw down those assets when needed.
Right, exactly.
We get a lot of questions on this one, Armando, right? I mean, the Medicare tax and IRMA, our retirees are definitely surprised to see that these, as they proceed through life, holy cow, they can't get away from Uncle Sam, can they?
Well, no, they really can't. Medicare may seem pretty darn simple. When you're 65, you have to apply for it. But that's the general rule, not always the case. Somebody who's retired military who has TRICARE, well, that's a special situation. And it has to be factored in when you apply for Medicare. If you're going to work beyond age 65, well, that's a little bit different as well. If you're going to have a big payout at age 64 or age 65 and it bumps up your Medicare premiums, Well, things can be done to also minimize that impact as well. So even though Medicare might seem extremely straightforward, that at 65 you have to sign up and take it, there are different factors that matter that can be used to your benefit so that that overall tax bite decreases, the Medicare premiums can decrease, and then in the broadest picture as well, making sure that that insurance coverage through Medicare plus supplemental coverage, that the family is completely covered as best as possible if there's a health issue that arises.
Right. And back to taxes, you got to make sure you're not trying to sneak around the IRS. We recently had a meeting with a so-called Medicare expert who suggested to the client that they shift income over to the spouse to avoid the IRMA increase. Well, now we're looking into, is that the appropriate tax saving strategy? So we're definitely going to talk about tax saving strategies, but you always want to make sure you don't go on the bad side of the IRS. So make sure if you are getting advice, it's from the appropriate experts, your CPA, tax preparer, etc.
Right. And we always engage the client's tax CPA in that conversation, in all conversations that could impact taxes, so that at the end of the day, there's no surprise for the client and the family.
Yep. Big section here, retirement plan issues. Of course, our firm, we always like to see our clients set money aside. One of the biggest tools we use are defined benefit plans or cash balance plans. We love setting those up and deferring those taxes. Maybe touch on some of that here, Armando.
Yep. Yeah. So, on this checklist, the top thing on there is traditional IRA. And yes, those are great tools to have, fantastic tools to make use of. And when a person owns their own business, that same idea of putting money away that is tax deductible to the business can really be on steroids. So, depending on the situation, what's called the employee census, it means how many employees do you have? What do you pay them? What on W-2? What are the ages of the employees? All of that comes into play. But at the end of the day, if we can put a defined benefit plan, cash balance plan, profit sharing plan in place, some kind of a pension plan for that small business owner, at the end of the day, if we can do that and put in a big chunk of money and get an enormous tax break for it, which we often are able to do, then it can dramatically decrease the taxes that that business owner is going to pay. So it works just like an IRA. You get to put away so much each year, but for a business owner using the ERISA laws to their benefit can put in enormous chunks of money. And was it a year or two ago, Tom, that we had a client put away $500,000 into his retirement plan, fully tax deductible, and that had a dramatic impact on his taxes that year. It was $500,000 of income that was not taxed that year because we created that plan and put the monies in. It'll be taxed later when that money comes out, but it becomes now part of his retirement money, and that money will get pulled out over the next 30 years.
Yeah, it's hard to believe, but yeah, that happened. And we've had numerous clients put $200,000, $250,000, $300,000. Huge impact, on that. And also, we like our clients to kind of set up some different buckets. So we also like the Roth accounts. Also, it's nice to have some options as you progress through life of which accounts that you want to draw down. Well, some of these tax brackets, they've got some big gaps between when you hit the next highest tax bracket. So can you maybe fill up some of those lower tax brackets with some Roth money? Now you're paying the taxes at a little bit lower rate, and then later on in life, you can just pull that out tax free. Or Roth accounts are great for legacy planning. But one of the things we want to make sure that we do at our firm is that we do set these accounts, or we do these Roth conversions, or we do non-deductible IRA contributions. We want to make sure that they're recorded correctly. They're also reported on the tax returns correctly. And that's where we kind of always want to make sure we get copies of our clients' tax returns, make sure the stuff that we did do is being reported correctly to the IRS.
Right. And keeping all those records for years, because 10 years ago, if you did something and set something up, we've got to be able to find those records if need be, so that we can validate that everything is where it needs to be and filed correctly, reported correctly, all those good things.
Yeah. We got three letters here. RMD. I've gotten asked about this when I'm out in public. What does it stand for? What does it mean? I'll say from my perspective, the IRS on a lot of these accounts, or Uncle Sam is still a partner in these accounts. So that's your traditional IRA, your traditional 401k, your traditional 403b,
Right.
your 457s. Now Uncle Sam is saying, hey, you got this tax deferral on the front end. Now I want to see some money coming out, which means you got to pay taxes on that money. RMDs now for most people 73 years of age, but that's part of our job is to make sure, hey, those are pulled out correctly. Because boy, if you forget to pull those out, there's some pretty serious penalties.
Right, exactly. And the RMDs, the it's a minimum that has to come out of that account every single year. And that amount is roughly 3.5 to 4% as a general rule. I'd say think about 4%. Well, what does that mean? Well, if the value on December 31 of last year is $1 million and you have to pull out 4%, that means that in this year you've got to pull out about $40,000, roughly, rough numbers. It's a whole table the IRS puts together, but just for general planning purposes, whatever the value, market value of that account was on December 31, then the year after that, the year following, you've got to pull out roughly about 4% to keep in compliance with the required minimum distributions.
So the next section is income related issues. Man, we got some funky verbiage up here that sometimes the public they go, what they we saw RMD over here. Now we got ISO, NQSOs, our issues. Any thoughts on that, Armando? Or
Well, it can become an alphabet soup. Yeah, restricted stock units are RSUs, and there are different acronyms out there. So it just goes to make the point that if you see something in documents that you have and you just aren't sure what the heck it is, you've got to talk with somebody about it. And your tax CPA might know what some of this is. They might not. Your business lawyer might know, might not. Your estate lawyer might know, might not. But in our place, we're touching each of those disciplines as the wealth advisor for that client. We have to understand enough to be able to help the client. And when we require that estate lawyer, we will take them to the estate lawyer. But these acronyms come into play with your taxes, and how it gets taxed is all prescribed, of course, by the IRS and their rules and regulations. But it just comes to show that if you, the person who has this document that is an RSU or any of those other acronym items, and you don't know what it is, you have to talk with somebody about it. You cannot make assumptions, because if you make an assumption wrong, or you get on the internet and look it up and say, oh, I know what it is, I'll just do this because that's what I read. Well, the internet has on it what somebody else wrote. Did they write that information down correctly? Do they know what the heck they're talking about? Maybe yes, maybe no. But we've been hearing more and more about AI hallucinating, meaning when you type something into Google and you read this version of a paragraph of what AI feeds you, a lot of that is wrong. And that's what people will call hallucination. So you cannot be wrong and then go to IRS and file something wrong. IRS is going to say, I don't care about your hallucinations. You did this wrong. Here's the penalty. Here's the tax. Pay me now.
yeah, 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 and that's a huge point that Armando's saying is that don't assume that your tax preparer or CPA or attorney knows that you even have this type of compensation. And your employer, a lot of times, isn't going to help you either. I mean, that's a lot of times we find out is that a lot of
Right.
times it
Right.
takes a lot of proactive planning to find out about this deferred compensation or there's this income or stock options, et cetera. But the sooner we find out, the sooner we can start planning from a tax perspective is, hey, what
Right.
are our options that are available as paying the taxes on this? So
Right.
that's huge.
Exactly. Exactly.
Other issues, we got the HSA. I mean, it's a favorite tool of mine. Holy cow, triple tax savings. A lot of times people or tax advisors or tax planners don't talk about this enough. But even though it doesn't seem like much, the contributions right here, $8,300 for a family, but man, you do that every year for 20, 25 years. And now you got a nice chunk of money set aside for health expenses or long-term care expenses coming down the pipeline, which we've seen personally and also a lot of our clients, man, that could be a lot of money later on down the road.
That's right. That's exactly right. And the new tax law that came out in July of 2025 has made some changes that may be more favorable to you with those HSA accounts. And the other, on this list as well, state specific. Every state sets its own laws as well. And for some states, what they'll set up is dramatic. So, for example, Florida, Texas, Tennessee, Nevada, they don't have any state income tax at all. In other states also. But some states like New York and California have very expensive state income tax rates. California is about 13.5%. That's just the state income. Some states impose estate taxes when somebody dies, like Washington State has very high estate taxes, whereas Arizona does not have estate taxes. So understanding the state laws in the state in which you live, and that's why some people will move to Florida or to Nevada because there are more favorable laws in those states for at least state income tax anyway. So it's important to understand what your state allows, what they don't allow, and it is state specific.
Yeah. Yeah, we got 529 account. Of course, that's your higher education accounts. We love to set those up for our clients. We use gifting to get those going. But then the other side of it is when you're starting to draw the money down, let's make sure that's done appropriately and reported correctly. So that's that point there. This one's a little tiny, two sentences here, but real estate, that's when I think you really ought to start getting a professional to do your tax preparation. When you start getting rentals, you want to make sure you're getting all the deduction, the depreciation is reported correctly. So that's a huge one right there. Any thoughts on that, Armando?
It is. And I'm always thinking about liability. So when you have a rental property, if a tenant gets injured in your property, who is responsible for that? Who is liable for that? Well, it's the person who owns that house. So it just brings the point that make sure you have a good lease agreement with your tenant. Make sure you have the appropriate insurance on that house. Make sure you have that home in the appropriate business entity. And make sure, as you said, Tom, that you're running the expenses through that business because it is a business. Make sure you're running that through correctly, filing correctly, and that you have a tax preparer who understands rental property and can help you maximize your deductions on that and file all those parts of that have to get filed correctly.
That's great. Any other following thoughts, or you want to finish up here?
Well, I'll just touch on this new tax law like we opened up with. The new tax law just came out in July of 2025. As we record this, this is the middle of August, just 1 month later. It's a brand new piece of legislation that the tax CPAs and the tax attorneys have to go through with a fine-tooth comb to understand the nuances of it so they can really make the most benefit of it for the use of the client. So you, as you sit here and listen to us talking, keep in mind a couple of things, and I'll mention just a couple of things about this new tax law that can be extremely, extremely impactful for the business owner. The bonus depreciation is 100% bonus depreciation. Well, what does that mean? What it means is if you buy, say, a machine to put in service in your company this year, this calendar year in 2025, and there are certain dates that matter. But if you spend $100,000 to buy a piece of machinery and you put it in work in service this year for your business, you can deduct $100,000. 100% of the expense can be deducted this year. That's what bonus depreciation is doing. So any business owner who has been thinking about buying equipment needs to think about that quite seriously and purchase the equipment and install it and have it in use in the business by December 31 to make full use, maximum use of that tax law for them. And there's also, as you mentioned earlier, Tom, rental property, there's this area that a lot of folks don't understand. It's called cost segregation. And a cost segregation study is done on a commercial building or a residential rental house. And what happens with the cost segregation study is you take that building and you break it up into its component parts for electrical, plumbing, roof, all this kind of stuff. Well, why would you want to do that? Why does it matter? Well, because with bonus depreciation, now you can take that roof as its own separate asset for to be depreciated and write the whole thing off. So bonus depreciation, I can't emphasize enough how significant that can be for a business owner, especially one who's thinking of buying new equipment or expanding for capital purposes, capital expansion this year for the company.
Yeah. All right, let me check for some questions. Let me look in the chat here, see if we got any questions here. One of the questions I see, the first one here is my tax preparer always puts me on extension. Any thoughts on that?
Sometimes an extension is the right thing to do. If you don't have everything ready to file on time, if you have it, but it's not quite clear and there's not certainty, if the tax law has not been fully interpreted yet, and it's unclear how it really should be handled to comply with the law, then an extension can be exactly the right thing to do. Some people are adamant, Tom, as you know, that they want to file on time. They do not want to extend because their thought is that if they extend, it increases the odds that they will be audited. I don't know if that's true anymore or not, especially with all of the cuts of employees and staff at the federal level. I don't think they have that much manpower left. They didn't have enough as it was to audit all the returns that they should have. There are even less people now. But an extension can be, it is a tool and it can be used and should be used when appropriate.
Yeah. Let me look here. So another question. I'm receiving Social Security. How is that going to be taxed and how do I report that?
I don't know that the tax law changed much for Social Security, but there are rules in terms of there's a certain threshold. If you make over a certain amount, then what you have is taxed. So if there's a way to shift income from one year to the next, it might be to your advantage to do that. Sometimes when you take Social Security, if you make too much, the Social Security gets withheld. It's not paid out. And so navigating that is important to do. I just went with a widow last week to Social Security, and we were told by the Social Security employee that if the widow made more than 1,950 a month, then it was going to decrease the payout that she was going to receive on her Social Security benefits. That's a whole nother maze that there are specialists that get involved with on Social Security, but that was what the employee told us last week. I don't believe that was a new rule, but certainly is what she told us. And now, Tom, as you and I are helping this widow get her financial plan together and get her life back together now that her husband is gone, we are cognizant of that and we will make sure that we're clear on what is the best solution for her with future income and taxable income, et cetera.
Yeah. Yeah, you can't get away from Uncle Sam. I know as when Social Security was enacted, it was meant to be for retirement. So I guess for some reason I don't like people earning income in retirement. So yeah, if you are earning income, then yeah, there's a threshold. There's a model mentioned whether you're single or married, filing joint. Once you get above that, then yeah, Uncle Sam's going to start taxing that money. So.
Yeah. Yeah.
And
And
then
we're
you get a
seeing,
1099. So as far as filing that, you'll get a 1099 from Social Security. And if you choose to have federal taxes withheld, it'll report that and you get that to your tax preparer and they'll put that on your 1040. So um, anyways, Armando, looks like that's about all our questions right there.
okay.
Great episode of death, money, taxes, and the law. We starting out with taxes because from our perspective, we don't see enough professionals doing tax planning. This is a great time of year to get with your tax professionals before they start ramping up and having to do returns for the September 15th and October 15th deadline. So if you're not doing tax planning, you should be, especially if you got rentals and own a business, etc. So,
Right. Exactly. Exactly. Great. Good.
well, thank you, Armando, and we'll see you next week
All right.
for next death, taxes, money, and the law.
Sounds perfect. Thank you.
Awesome. Thank you.